Hi guys, welcome back. This is Sam for Wealthwise. Today we are going to talk about the concept of bottom fishing the stock market. Uh, Traditionally, whenever the Feds have started to cut down rates, the stock market had a decline for the period of 9 to 12 months and sometimes a year and a half, which is 18 months. So it's important to understand that this is an opportunity for common men and general public to kind of invest and get the returns or and get the multiplying factor of 5x or 10x, because during the down period your value of money is like you're buying it on sale and it's on auction and you get more value for money, and when the uptrend starts you can 2x 3x 5x 10x your wealth. So let's look at how can we do this. So the strategy is called the pyramiding strategy. And why it's called pyramiding strategy? Because the pyramid is like this, and when the bottom of the pyramid defines the frequency, the top of the pyramid defines the start of the downturn, and the bottom of the pyramid decides where the market really stops. So I'm going to explain it. Let's assume the market drops by 20%. And how can you bottom fish at 20%? If the market drops 30% or 31, 32, 33%, how can you bottom fish at 32, 33, 34% and still get the maximum leverage of the downturn whenever the market downturns? In the ideal scenario, you would want to increase your investment during the downturn, because these are the golden times when you're getting something on sale. So it's like you're getting a house on auction and you're getting it very cheap, and you can basically resell it after a couple of years for double the money. So similarly in the stock market, there are opportunities when the dip comes, and those are the opportunities when you really want to capitalize. But before we start that, fundamentally, I just want to say I'm not a stock investor who's advising you what to do. You are free to make your own judgment, and that's just a disclaimer for this video. But the strategy I'm talking about, I've successfully used this in 2009 and 10 downturn. So I 10x the money, actually I 20x the money, and I bought a real estate multiplex condo in US, and that has consistently given me a return of 4 to 5,000 USD a month. I initially invested $35,000. It went down to maybe almost $500,000. I sold my stock. I invested into a fourplex, and that fourplex generates that amount of money that I started the stock with every year. So it 100x the money, and this has been 2010 to 2000, after 7 years, right? So I get 100% return because I pivoted from the stock to the real estate. And there was a time when I thought, hey, I've 20x the funds, let me get out of this and do something else. And I could figure out that real estate, the other one, which is actually a lagger, and it lags the stock market in terms of downturn. And it really went down and it was down from 12 to maybe up to 17, and I was able to buy the real estate in 2017, and the real estate has become 2x, but the investment has started paying me the amount of money I invested in the stock every year. So let's talk about the bottom fishing and how you can kind of leverage maximum amount of money when the market is at the worst or the lowest, right? We expect this to happen in the coming months, because the moment the Fed starts cutting the interest rate, traditionally the market has bottomed out 8 to 12 months after that. So we're talking, if the Fed starts cutting the interest rate in September, we're talking till next October, it might hit the bottom, right? So starting from early next year or the second quarter next year, and second and third quarter would be the best period to invest from historic standpoint. Again, I'm not an investment counselor. It's my personal opinion, and you are free to make your own judgment. But let's talk about this pyramiding strategy, how I capitalize on the pyramiding strategy during the downturn of 2009 and 10. And I'm looking forward to do that again. and I wish you guys can join in the journey. And for that, you have to save some capital. Typically, you would dollar cost average. And if you are a conservative investor, then I'm not talking about, the swing traders or the day traders or the options players or the seasoned hedge fund investors. I'm talking about the common man here. So how can you take advantage of this downturn? So let's get started. So number one, I'm going to look at the overall, geopolitical situation worldwide. So wars, climate changes, events happening, political changes happening across the world can impact the stock market. During this macro events, there are micro events which are industry specific. So if there has been an embargo on EV market might go down, but at the same time, AI market might go up, right? If there is a pandemic coming, the healthcare market might go up. So there are events that happen, and these events are called opportunities in the stock market. And if you look at the right companies which are playing in that market, you will definitely make a lot of money. But the concept of this bottom investing is what to choose, number one. And I'm typically going to start with ETFs. And let's start with the standard ETF like Vanguard, overall stock market called VOO. I mean, you could also start with Charles Schwab dividend ETF like SCHD. I invest in both of these, right? And the best way to approach for what we call it the lazy investor or a couch investor is to invest in the ETFs or the mutual funds. There are bond markets as well. You can invest in bond market. So there are investment opportunities both in triple leverage funds like TQQQ, right? Or you could just invest in sometimes during the downturn in the short, in shorting of the ETF like SQQQ as well. But let's talk how can we invest and make money out of this downturn. So here we go, guys. Let's talk about the pyramiding strategy. So I'm going to draw a pyramid just to kind of explain this in clear terms to you. So let's say that the top of this pyramid is the top of the stock market. And let's take NASDAQ as an example. So the NASDAQ, let's assume, is at 20,000 currently. And at the bottom, let's assume the NASDAQ will hit 10,000. And this has happened in the past. The stocks in the NASDAQ are impacted the fastest. The Russell 2000 stocks also get invested very quickly. Or rather impacted very quickly. But here we are talking about the NASDAQ just as a case study. So my investment would be in the instrument called VOO, overall stock market index Vanguard, and it's kind of a index fund which normally has traditionally given you average, I would think would be 15% return per annum and 1.4% dividend on an annual basis. So what I would do is, let's say the stock market goes from here and it goes down and hits 10,000 in a period of, let's assume 12 months. So I'm going to say 12 months. So I'm going to divide this into, so this is 50% drop into 5 parts. So 10, 20, 30, and let's say 40, and this is 50, right? So I am going to look at a dollar cost investment of $100. That $100, whatever number of units I get in that $100, what I'm going to invest as a case study here. So when I'm at zero, I'm at the peak, I'm getting one, let's assuming the unit is $100, I get 1 unit of the stock, one stock at the peak of 20,000 NASDAQ figure. I think it's around 500, but I'm just taking 100 as an example. moment the stock starts dropping, and this is my milestone of 10% drop. This is my milestone of 20% drop. This is 30, 40, and this one is 50% drop. I'm taking 50 an example. I don't know where the stock market is dropped. So let's say the drop starts at 20,000 and it's going to stop at 31, 32% approximately. So how will I buy stocks right at 32% drop, right? Let's look at that. So the pyramid strategy focuses on same amount of money. You can obviously increase the amount by the percentage of drop, which is what I do, but you can invest the same amount of money and you can actually increase the frequency. So as the stock keeps dropping, we are going to chop off that $100 into smaller amounts and keep investing same amount of money but in higher frequency every day. So let's say how to do that. So let's say this $100, when it drops at, let's say 5%, then I'm going to divide this 100 between 0 to 10 into two pieces. Like I'm saying, I'm going to invest 50 here and 50 here. So I've invested in blocks of 50, dollar cost average in the same day. So I automate the system inside the online stockbroker and say, buy at 5% drop $50 worth of units or stocks and buy at 10% $50. So let's assume the stock for a minute drops at 6%, then you'll end up buying at least $50 here, right? Now next, we move to 20%. Let's say now the stock is dropping and it's going to hit 20%, which is the correction territory. So we are going to change this block and divide the frequency into 4 parts. So this same $100 is now going to be divided into 4. So it's going to be 25, 25, 25, 25. And in terms of percentage, I'm going to put it at buy, good till cancelled, buy at 12.5%, $25, 15%, $25, 17.5%, $25, and at 20%, $25, right? So same amount of money is now divided into 4 pieces, and in the same day, I've divided into 4 good till cancelled orders at a drop of 12.5, 15, 17.5, and then 20. So originally I took an example of, let's say the stock drops to 32%. Now coming down to 30, I'm further going to increase this frequency by 8, right? So 8 divided by 100, right, will be roughly $12.5. Let's assume $12.5, right? So now my blocks change from 25 to 12.5. So, and the 10% here, I'm going to divide by 8 because now I'm buying at the frequency of 12.5. So typically I would buy at, let's say, 1.5% or 1.25%. So 21.25, I buy something, then I add 1.25 to it, then 22.5, I buy another $12.5 worth of stock. So what has happened is, as it keeps hitting 30, I've bought at every frequency here, right? I do another thing at every milestone, and I'm calling this 10% milestone. I invest on the $100, right? It's called a milestone because I'm from the project management side. I believe in milestone, and when it does 20%, I another invest another $100. Those are milestones, 10, 20, 30, and then at 30, I buy another $100. So what I've done is if it has 30, my dollar cost averaging is making it better and better because number one, I'm not missing at where it's stopping. Number two, at every milestone I'm buying. You can also put up milestones in the middle. Let's say you can also have a milestone at 25%. You can also do $100 here. Now coming down to 40%, so let's say the stock is going on down to 31, 32%. Now I've done till 30%, and now I'm going to divide this 100 into 10. Simple maths. So I'm going to buy $10 at every percentage drop. So 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And 10. So $10 with every percentage drop plus the milestone. So I'll also buy at 35%. But let's say it stops at 32% here. The market stops and starts recovering back However, I bought at milestones of each of these blocks. I have bought a stock. I have also completed some milestone buying, 10%, 20%, 30%, and then at 32 it stopped. I didn't hit my 35% milestone, but I also bought at 32%. So I've actually done good enough, and my overall stock buying would be, on average, I would have bought at 20% bottom, though it has a 31, 32. And when it bumps up, which traditionally has in next 2 to 3 years, you will get a multiplying factor of 2x, 3x, 5x, or 10x. And this is just for the ETF. Now, if you do it at industry or a sector, which is a PE, which is fair market value, let's say 15 times their PE, and stock is trading at 15 times PE, or if it's trading at 20 times PE, this will be even better than where it is, right? So this strategy I've successfully used. I currently started investing back in the stock market after 2010 and buying real estate 2017, which has doubled in value, and the rent has also doubled. And the money I'm getting from that, I started investing in 2022, and I have done fairly well through this strategy. Currently, my portfolio sits at 300 to 400% gain, but this also includes my SIP, which is in India I would call as systematic investment plan, but in US or Canada I would call it a DCA, dollar cost averaging. But it's a recurring investment that goes from my bank and directly sits into the structure. Now you can build an algorithm to do this, and I know there are algorithms in AI existing to do this, but you can also set this up manually in an automated way and go to sleep. And then when you get up, like let's say assume you're a passive investor or a couch potato investor, and you get up after 5 years, you will see that you have 2x, 3x, 5x, or in some cases 10x your wealth just on the ETF side. But if you have done it with the stock, which has a fair PE ratio and which is an upcoming industry and it has gone down because of geopolitical factors and the macro and micro factors I talked about, then you can 10x or 20x your wealth. So hope this strategy of mine helps you, and you can use it smartly to, if you're a software guy, you can build an algorithm out of this, but if you're not, you're a common man, you can use this to set up your portfolio, and you will see the dividends coming back to you in the next 3 to 5 years. So if you like this strategy, please do like and subscribe this channel, guys. And I will like to share more of such strategies with you in the future, including the businesses I run. I do own multiple businesses. I have got real estate investment and the stock investment portfolio, as well as fixed income instruments invested for what we call it the fire generation, but also for the baby boomers. So I look forward to hear from you again. And this is Sam All signing off for WealthWise. Thank you, guys.